Hey everyone, get ready because today we're tackling a massive, and I mean massive, $3 trillion mystery that is currently threatening the global innovation pipeline. Welcome to this explainer, where we're going to unpack a super fascinating report from the World Economic Forum and Stanford University, all about the state of venture capital. We hear about startups and crazy funding rounds all the time, right? But right now there's this hidden traffic jam in the financial plumbing of the tech world, and it actually affects everything from the apps on your phone to the future of healthcare.
To really grasp the macroeconomic stakes here, consider this. 7 of the 10 largest companies in the entire world today by market capitalization were built on venture capital. We're talking about Amazon, Apple, Alphabet, Meta, Microsoft, Nvidia, and Tesla. Less than 0.1% of new businesses ever receive VC funding, yet look at the world around you. This tiny fraction of companies holds a remarkable concentration of the global economy's value.
And the sheer scale of this impact is just staggering. Even though it's a tiny sliver of overall funding, VC-backed firms drive a whopping 94% of all research and development spending among public companies founded in the last 50 years. That means if you want to know where the future is being invented, whether we're talking about artificial intelligence or clean energy, it is overwhelmingly being bankrolled by venture capital.
So, here's our roadmap for this explainer. We're going to look at the innovation engine, how venture capital actually works, the stalled exit problem, the resulting liquidity squeeze, and finally, how we go about fixing the venture model.
All right, part 1, the innovation engine and how it powers global breakthroughs.
You know, venture capital isn't just about making money. It's the critical engine building our future, funding the heavy research required for advanced AI and life-saving biotech way before those products ever see a single dollar of revenue. To understand how this engine got its fuel, we actually have to look back to the 1970s. Managers of massive U.S. pension funds had severe legal constraints stopping them from investing in risky assets like venture capital. But a regulatory spark, specifically the 1974 ERISA Act and the 1979 Prudent Man Rule clarification, changed absolutely everything. It allowed pension funds to allocate capital to high-risk, high-reward ventures. Actually, scratch that, it wasn't just a spark, it was an explosion. The market cap of VC-backed firms went from just 1% of the US total before ERISA to a staggering 41% by 2025. It really goes to show how the right regulations can completely unlock innovation.
Moving on to part 2, how venture capital works, specifically those recycling mechanics.
The contrast here is absolutely crucial to understand the unique rules of this game. Traditional finance, it's all about minimizing risk, banking on collateral, and demanding quarterly returns. Venture capital is a totally different ballgame. They embrace massive failure. In fact, evidence shows the failure rate for VC-backed companies can reach 75%. But VCs accept this over decade-long horizons because they aren't looking for steady dividends, they're hunting for extreme, rare outliers.
It's what we call the power law. And legendary investor Bill Gurley hits the nail on the head here. He says, if you invest in a company that fails, you lose 1x of your money. If you miss Google, you miss 10,000x your money. In this model, missing a rare exponential breakout is mathematically way worse than funding a dozen duds.
So this creates a continuous high-stakes recycling loop. Capital forms from investors, gets deployed into startups, those startups scale up, achieve liquidity, usually by going public or getting bought out, and finally cash gets distributed back to the investors to start the cycle all over again. But here's the kicker. The whole shebang relies on step 4, liquid exits. Without those, you literally cannot fund the next wave of founders.
Which brings us to part 3, the stalled exit, and the breakdown of this cycle.
This is the core inciting incident of our explainer. The exhaust pipeline of this massive recycling engine is totally jammed. The data forces us to ask one really crucial question. Why are hyper-valuable companies, the nearly 2,000 unicorns globally, worth over $7.3 trillion suddenly refusing to go public?
Back in the 1990s, we had nearly 1,600 tech initial public offerings, or IPOs. The 2020s so far, a mere 227. Private markets have gotten so flush with capital that startups can raise massive sums without the headache of going public. But there's a catch. When they do eventually list, they're way less profitable. In the 90s, 60% of tech IPOs were profitable at listing. Today, that number is barely 26%.
Because companies are scooping up private capital so easily, the median timeline to reach an IPO has blown up to 12 years. 12 years. That means some early investors have been waiting for a payout longer than fans have been waiting for the next Game of Thrones book. We're seeing major names like SpaceX, which raised its early VC round back in 2005, and Stripe, founded in 2010, staying private for well over a decade. The capital that funded their early growth is effectively locked inside a vault, totally unavailable to be recycled.
And as this waiting game drags on, we're seeing a massive geographic scale-up gap widening. Startups are founded everywhere, sure, but scaling them takes immense capital. In North America and Asia, roughly 1 in 60 VC-backed companies becomes a unicorn. But in Europe, it's 1 in 135, and in sub-Saharan Africa, it's 1 in 330. Brilliant international startups are basically forced to relocate to deeper capital hubs like the US or China to scale up, which severely centralizes global innovation.
Okay, part 4, the liquidity squeeze. Basically a massive traffic jam.
So what happens when billions of dollars get stuck in the system? Well, right now we have an estimated $3 trillion, yeah, trillion with a T, in unrealized value trapped inside VC funds globally. More than half of that is just sitting in older funds launched in 2019 or earlier. It's paper wealth that exists, but nobody can actually spend or reinvest it.
And here is the core paradox. Because companies aren't exiting, distribution ratios have absolutely plummeted for recent fund vintages. The cash going back to the limited partners, the pension funds and endowments that supply the money, is crashing. Investors are only getting back about 60 cents for every dollar they'd normally expect right now.
It's created an unprecedented cash flow crisis. Since 2022, U.S. venture funds have pulled $196.9 billion more from their investors than they've actually returned. It's a massive capital deficit that's choking the intake valve for new startup capital. If investors are bleeding cash, they're simply going to stop funding new venture funds.
Which leads us into our final section, Part 5, Fixing the Venture Model, Adapting for Survival.
Now, the industry isn't just sitting on its hands. Actionable solutions are emerging, because if those limited partners don't get their distributions, they simply can't fund the next generation of visionary founders. A real game changer here is the rapid rise of secondary markets. Secondaries let existing investors sell their shares directly to new buyers while the company stays private. This used to be super niche, but recently secondary transactions in the US reached $106 billion, growing 83% year over year. It represents nearly a third of all VC exit value now, stepping out of the shadows as a desperate pressure relief valve for trapped capital. To clear this $3 trillion traffic jam for good, the World Economic Forum report lays out some clear strategic fixes. We absolutely have to improve that secondary market infrastructure beyond just the top 20 mega companies. We need to mobilize institutional capital by reforming regulations globally, just like ERISA did for the US back in the 70s. We have to reduce cross-border red tape, strengthen talent pools, and enable strategic government participation. Without these reforms, we're basically heavily taxing future global innovation. So that leaves us with one massive, provocative question. We know that venture capital built the digital age we live in today, but with the engine completely jammed right now, what world-changing technology, what cure, what clean energy breakthrough, what crazy leap in artificial intelligence is sitting unfunded right now, just waiting for us to unclog this wall of cash? It's literally a $3 trillion question that's going to define our future. Thanks so much for joining me for this explainer, and definitely keep your eyes on those private markets. The next big shift is already underway.